A new situation that is being tested is that of a re-audit. In this situation, an auditor has completed the client's audit when the client decides to obtain another opinion on the very same year. This usually occurs when the first auditor was a small firm and now the company decides to hire a big-name, widely known firm to audit them again, because the client is getting ready to go public and issue company stock on the major stock exchanges. They know their stock will sell better with a big-name audit report attached to the financial statements. The new firm is known as the successor auditor and must ask the former auditor the above 4 questions. The successor will do this before they accept the engagement to re-audit. The successor will also review the predecessor working papers for the year under re-audit and the previous year. Candidates, stay awake here. Remember that the new auditing firm, the successor, must conduct an entire audit and perform all of the necessary audit procedures. The successor auditor cannot use the work of the former auditor. One problem often occurs, however. The successor auditor is appointed too late to observe the physical inventory. In this case, the auditing standards suggest that the successor auditor use alternative procedures to verify the inventory, such as analytical procedures like gross profit tests. When a company has been re-audited, they have 2 audit opinions on the same year. Only one audit opinion is used with no mention of the predecessor audit in that report. Yes, a re-audit year is expensive, as the client must pay for 2 audits. However, the value is in the image portrayed to the general public when a Big 5 or other large auditing firm's report is issued. Okay, now the auditor is ready to actually begin the engagement. The first step the auditor does each year is to establish an understanding with the client about the services to be performed. This understanding is required by GAAS and may be either a verbal communication with the results documented in the work papers or a written communication, such as an engagement letter. Note that an engagement letter is not required by GAAS. What is required by GAAS is that the auditor document the understanding. When should the understanding be established? Before the audit begins. Why establish an understanding? To reduce the risk that either party, the client or the auditor, may misinterpret the needs or expectations of the other party. The understanding should include 4 main points. 1. The objective of an audit, which is to express an opinion on the financial statements. 2. Management's responsibilities, which include complying with laws and regulations, preparing the financial statements, maintaining and devising the internal control process, establishing procedures to prevent and detect fraud, and making all financial records available. 3. The auditor's responsibility, which is much simpler than management's. The auditor simply follows GAAS, which includes obtaining an understanding of the internal control process and expressing an opinion on the fairness of the financial statements. And finally, 4. The understanding should include the limitations of an audit. An auditor only provides reasonable assurance, not absolute assurance, on the fairness of the financial statements. And the auditor is not providing assurance on the internal control process. However, if the auditor becomes aware of any control problems, known as reportable conditions, the auditor will communicate those to the audit committee. An audit does not include the detection of immaterial error or fraud. Of course, the understanding may include the fees, the name of client contacts, a list of client schedules, and the involvement of specialist and internal auditors. What were the 4 factors that must be included in the understanding with the client? 1. The objective of an audit. 2. What management is responsible for. 3. what the auditor is responsible for, and 4, the limitations of an audit. Don't forget when the understanding should be established, before the audit begins. If the auditor chooses to document the understanding in an engagement letter, the letter would be prepared by the auditor, addressed to the client's audit committee, and given to the client before the audit begins, with space for both the client and the auditing partner to sign. Once signed, the engagement letter serves as a legal contract between the client and auditing firm. Well, the auditor has accepted the engagement, established the understanding, and is ready to begin the audit. The real audit planning now begins. A common essay question requires candidates to identify planning considerations and procedures. Before we cover a list of what an auditor must do as they plan the audit, let's get the mental picture of where an auditor would be when the planning takes place. You guessed it, the auditor is back in the office with his feet up on the partner's desk, looking out over the ocean, lake, or mountain range. Wow, we only wish. But use the picture to help you answer the common multiple choice question asking about which of the following items would an auditor be most likely to perform when planning an audit. Picture yourself in the office and it's easy to see the answer. You couldn't possibly select transactions for testing, reevaluate the sampling plan, or confirm accounts receivable from back in the office. From your office, you could read last year's financial statements, begin to rewrite this year's audit program, and read this year's interim quarterly financial statements. You could email the client a list of schedules, but you would not be performing any tests of details or tests of controls. Some of the factors an auditor would consider during planning are new accounting or auditing procedures, the extent of technology usage, the use of outside service centers, the use of internal auditors or specialists, the applicable government regulations, the client's business and industry, and the client's accounting policies. Do you know what I mean when I say accounting policies? I mean the client's choice of GAAP, generally accepted accounting principles. For example, GAAP allows your client to choose from 4 acceptable depreciation methods. The method chosen, such as sum of the year's digits, is one of the client's accounting policies. These accounting policies must be disclosed by the client in the footnotes to the financial statements. Don't forget, the client prepares the financial statements and selects the accounting policies. The auditor just audits them to see if they are fairly stated in accordance with GAAP. Please know the following list of procedures that the auditor typically performs during the planning process. Reviews prior year's financial statements, the current interim financial statements, and the correspondence files. Discusses with non-audit personnel, such as the tax and consultants working for the firm, what they might have completed during the year. If your firm's consultants put in a new inventory system with excellent internal controls, then you may plan to spend some time documenting the new system, performing tests of controls, and perhaps decreasing the amount of substantive testing. Of course, before you accept the engagement, conduct an inquiry of the predecessor auditor if applicable. Inquire, ask the client about new business developments. Meet with the audit committee to discuss your understanding of the services to be performed. If in writing, obtain a signed engagement letter. Consider new GAAP and GAAS that may affect the audit. Coordinate the assistance of client personnel to prepare schedules. Coordinate the firm's staffing. Arrange for adequate working space. Establish a time budget. Hold a planning conference with the staff to inform them of technical and personnel aspects. Prepare the written audit programs, lists of steps to be performed. Make a preliminary assessment of materiality. Make a preliminary assessment of audit risk. Specifically assess the risk of fraud causing the financial statements to be materially misstated. Perform preliminary analytical procedures. Know the above planning procedures. They are tested via essay questions, other objective format questions, and multiple choice. For examples of these question types, see my book, Get Motivated, You Can Pass the CPA Exam, available from John Wiley & Sons. How does the auditor make a preliminary assessment of materiality?